Hello viewers and welcome back to the Stop Hunter. In this video we're diving deep into a very powerful bit of science, mathematics, very simple to use, but it can transform your trading. It can help you manage your risk and maximize your returns. It really is very simple, but you have to understand it thoroughly before deploying it. And before we even get into how you can actually use it, let's dig into a bit of history, to the Kelly Criterion to see why it is just so good. Now, the Kelly Criterion was developed by a guy called John L. Kelly Jr. in 1956. Now, originally, it was used to improve the efficiency of telephone signal transmissions, but quickly gained fame in the world of gambling and investing. Why? Because it provided a very simple mathematical formula for determining the optimal size of a series of bets to maximize the growth of your capital over time. So the basic idea is that the Kelly Criterion helps you determine the exact fraction of your capital to wager on your trade or bet based on the probability of winning and the potential return if you do win. So it's all about finding the sweet spot where you can grow your wealth as quickly as possible while minimizing the risk of going bust. So what does that formula look like? So as I mentioned, it's a really simple formula, and here it is. It is Kelly percentage equals W minus, then in the brackets there, 1 minus W, close brackets, divided by R. So what does that all mean? R is the average win-loss ratio, W is the historical win percentage, and the Kelly percentage is the end result. That's the fraction of your capital you're going to invest. So let's put that into a practical example so you can see it working. Right, so in this example, imagine that you have a 70% chance of winning a trade and the risk return ratio is 1 to 1. What does that 1 to 1 mean? Well, that means for every £1 or $1 you risk, you're going to return £1 or dollar. And there's our formula again. So let's just plug those numbers in. You can see the 70% chance is just converted there to the decimal 0.7. And it comes out, well, after putting in the 1 for the risk reward part of the trade in the R, comes out as 0.4, i.e. 40%. So that's basically telling you, if you had $10,000 in your account, you would risk 40%, of that on your trade. Well, that all sounds very simple, but I can hear what you're saying already is, well, 40% of my funds. Wow, that just sounds too risky. And you're right, betting large fractions of your capital can lead to significant volatility losses. So that is why traders use different versions of Kelly, often called fractional versions, to smooth out the ride. But before we look into those different methods, I just want to touch on the fact that the Kelly Criterion can be a defensive and offensive tool. So let's think on the defensive side for the moment. You've come up with a strategy, you've back tested it, you've got some numbers under your belt, or maybe you've been live trading it on small amounts to get some history because you can't do a full back test. And it's basically telling you you've got a 40% chance of winning a trade, and the risk return, as you've been finding, is 1 to 1, and we know what that means now. Now, if we plug those numbers in to the Kelly formula, comes out with minus 20%. So straight away you see a negative Kelly is telling you do not trade, do not pass go, don't collect your $100, forget that idea, move on, find something else. So what it's telling you is, from the defensive point of view, don't waste your time here, find something else to do, like I said. On the flip side though, it confirms, if you've got a positive result, that your strategy has an edge. So the Kelly Criterion not only shows you that your idea is working, but it also encourages you to trade a bigger size to capitalize on that edge. I suppose it's like your green light to scale up and maximize your potential returns. So remember, the Kelly Criterion can tell you when to go big and when to stay out, ensuring you're only trading when the odds are in your favour. So that's why understanding your statistics, your trading statistics, and incorporating those into the Kelly Criterion, into the decision-making process, can be a game changer. So now we've seen the sort of strengths and the versatility of the Kelly Criterion. Let's do a quick SWOT analysis of the traditional approach so you fully understand the strengths, weaknesses, opportunities and threats. Let's talk strengths then. Firstly, optimal growth. It's designed to maximize the geometric growth of your capital over time. It's mathematically proven to outperform other betting strategies in the long run. Also built on quantitative foundation, solid math principles behind it, giving traders a systematic way to size up their trades. And it's also self-correcting. As you win or lose, the Kelly Criterion adjusts the size of your bets accordingly. So it does help you manage the risks, as your capital changes. What about weaknesses then? Well, high volatility, obviously. The full Kelly Criterion, as you could see by that 40% example, can lead to large bet sizes, which can cause massive fluctuations in your capital. And that volatility, I can tell you, takes some nerve. It can be nerve-wracking, especially during losing streaks. Secondly, overconfidence in estimates. If you're not accurately giving the Kelly Criterion decent input, it's garbage in, garbage out, I'm afraid, and it's going to mess up the estimates of probabilities and returns accurately, and that can equal losses and poor results. And potentially there, finally, for large drawdowns, the big bet sizes, even a small series of losses could potentially wipe you out and be very difficult to recover from. What about opportunities then? Well, it helps you to adapt to personal risk tolerance. You can tailor your strategy to match your risk appetite while balancing growth with safety. Obviously, diversification, it can be applied across different assets and trading strategies with different results. So you're getting different sizes, for diversified risk management. And like I said there, mentioned before, improving your risk management by incorporating maybe a fractional adjusted Kelly method, which we'll see in a minute. You can reduce those risks of large drawdowns while still benefiting from the Kelly strategy's growth potential. And finally, threats, pretty obvious. Market volatility, as we mentioned, highly volatile markets, even with a good, accurate Kelly calculation, can lead to large losses as those market conditions change rapidly. Obviously, the psychological pressure when you start scaling up to much bigger size, well, it can find you out. Handling large bet sizes, potential for significant losses, can lead to emotional decision making, which could derail your trading strategy. And estimation errors, we mentioned that already. Incorrectly estimating probabilities or expected returns can lead to overbetting, and again increase that risk of significant financial losses. So what does this SWOT analysis tell us? Well, while the traditional Kelly Criterion is a very powerful way to maximize long-term growth, it does come with significant risks, especially for those who might struggle with market volatility or the psychological pressure of large drawdowns. So that's why many traders look for alternative methods to the Kelly Criterion that still leverage its benefits. You're basically adding layers of risk management to the process, and that's exactly what we're going to cover now. 6 optimal fractional Kelly approaches. Let's start with the half Kelly approach. It's one of the most popular methods because it strikes a balance between maximizing growth and minimizing risk, and it's a pretty simple idea. You just take the full Kelly Criterion and divide it by 2. So 40% from our previous original Kellys divided by 2 equals 20%. So that means you'll be risking 20% of your capital Why is it any good this way? Well, it reduces volatility, making it easier to stick to your trading strategy through the ups and downs. Similar to the half Kelly approach, we've got the quarter Kelly approach, basically just dividing the full Kelly by 4. So if our example was 40% for the full Kelly, divided by 4 equals 10% of our capital. So it's a more conservative approach, for the ideal for those who want to maybe minimize the risk further, especially if you're trading in more volatile markets, or maybe when your confidence in your probability estimates isn't that strong. Another popular method is the 3/4 Kelly approach, basically taking 75% of the full amount. So, in our example, 40% was the full amount, times by 75% equals 30% to be used on your capital. Why is it good? I suppose if you've got very strong confidence in your strategy and want to take on a bit more risk for potential higher returns. Next up, we've got something called the optimal Kelly with risk aversion factor. Now, what does that mean? Well, it's just highly customizable approach because you can adjust the Kelly fraction based on your personal risk tolerance. For example, if you're maybe more risk averse, you might only bet 30% of what the Kelly criterion suggests. And to use this method, you multiply Kelly fraction by your risk aversion factor, anywhere between 0 and 1, depending on how much risk you're willing to take on. The fifth approach is called the Kelly with max drawdown constraint, and this approach modifies the Kelly bet size to ensure your drawdowns stay within a predefined limit. Now, for example, if you're unwilling to tolerate more than a 20% drawdown, you'd adjust the Kelly fraction accordingly. A good method, I suppose, for traders who are very focused on capital preservation and want to avoid large losses at all costs. And finally, what I like to call the TheStopHunter Kelly approach. I suppose it's something I've come up with myself when I've been trading. Often overlooked how many losses you get in a row in your strategy, and the higher the Sharpe, the less the Sharpe ratio, that is, less you're probably likely to get. So you can factor that in. I know that I have decent high Sharpe ratio strategies, and I know from my back tests and results what a losing streak looks like. So for example, if we got 40% as the full Kelly criterion, and we knew that we were anticipating a losing streak of 5 trades, say, we could just divide the 40% by the 5 and we get an 8% bet size per trade. So this way, even if you're hitting that losing streak, your capital won't be significantly depleted. So let's summarise those different approaches you can see there in the table. Well, the half Kelly gives you a more balanced approach. Quarter Kelly, a conservative, lower risk approach. 3/4, more aggressive. The optimal Kelly with the risk aversion factor, tailored to your own tolerances, your risk tolerances. With the one with the drawdown, number 5 there, it's going to keep you within comfortable limits, and the TheStopHunter approach there, adjusted for losing streaks, so preparing you for those. So really it comes down to your own personal risk tolerance, the nature of your trading strategy and the market conditions you're dealing with. But those are some of the most popular methods for utilizing Kelly criterion within trading and investing, especially if you don't want to use the full approach. So I'm hoping you can see how effective the Kelly criterion can be if used correctly. You've got to fully understand it first before utilizing it into your trading. Remember, it can be your safety net as well to the downside. It's telling you, enough's enough, your trading's not working, that strategy doesn't work, move on, find something else to do. But also on the upside, the offensive side, it gives you the green light, telling you that your strategy is worth extra capital, optimizing so you can get much better returns. Always do, like I said, your due diligence first before deploying such a theory into your trading. Understand it fully. You know, if you just go into it willy-nilly, it can be a dangerous tool to use as well. But it is very simple, and if used correctly, like I said, highly effective. I like it. I use it in my trading. Love to hear your thoughts on that in the comments below. Do you use any of those different methods that you've seen me present there today, or do you use something like I've come up with the loss sequencing into the strategy of you know, the Kelly formula? Like I said, love to hear those thoughts. Now, if you've liked the video, please give us the thumbs up. Don't forget to hit the sub and bell icons to receive future notification of content that we will be producing like this on the channel. Now, got a playlist coming up for you as well. If you're new to trading, want to come out the other side a hero, work your way from the top to the bottom, and you should be in a much better place to do so. That playlist coming up now.